This is Terrence Andre Banks with Information Age Financial Solutions coming to you again about the real estate market. Came across this fantastic article by MarkWatch.com. I'm going to put a link inside the description. Real estate is a big part of the American dream, and when things, as talked about before, are getting challenged, it's definitely time to pay attention and see where the opportunities might lie, also where the problems are, so you won't be caught by them and be a victim. As mentioned, I'll put a link inside the description. This article is really in depth, and I'm just going to dive right in. Real estate industry sees no problem, hears no problem, or speaks no problem, which is well said. If everyone wants to know what's the impact the coronavirus and the government response will have on the housing markets, while it's too early to hazard a guess, some things are becoming increasingly clear. Already it looks as if the U.S. is moving towards a temporary moratorium on mortgage payments. Fannie Mae and Freddie Mac unveiled an emergency program which provides a 2-month deferral of mortgage payments for any homeowner who claims to be facing hardship because of the virus. And I did a video about just be much more mindful of when they offering these free different options. It does come with a cost. The payments will be tacked at the end of the mortgage term. In this case, Fannie and Mae are doing that. The Coronavirus Rescue Law just enacted by Congress includes a provision which requires all firms that service federally backed mortgages to grant a forbearance up to 360 days for any borrowers who say they have been harmed by the coronavirus outbreak. It is not much of a stretch to say the virus has changed everything. Many of you may sense that the virus has undermined what you thought was still a fairly strong housing market around the country. In truth, the so-called housing recovery since 2010 has been little more than a carefully constructed illusion. Well said. Let's dive more into that. The belief is in a strong housing recovery was carefully devised using a strategy of misleading information, withheld data, and false impressions. Again, Reed's Housing Markets in Danger of Coronavirus Related since the recession. Well, if you time to take a look at it from there, but let's continue on with the article. As I explained in recent columns, the strategy to turn around a collapsing housing market unfolded in 3 parts. 1, restrict the number of foreclosed properties placed in the market. Now, if you've ever been inside the space, and which I have been, working the banks in the foreclosure department, they had so many on the books that they didn't release, which then gave a false impression they never really did that. You restricted the number that hit the market, just increasing the numbers there. 2, radically reduce the number of seriously delinquent homes actually foreclosed and repossessed. And 3, provide millions of delinquent homeowners a mortgage modification as an alternative to foreclosure. This strategy fooled nearly everyone into believing that the disaster has been overcome. With so few properties foreclosed and even fewer placed in the market, home prices had nowhere to go but up. Well said. The best example was in Los Angeles County, ground zero for the collapse. In 2008, more than 37,000 properties were foreclosed on. The plunge in foreclosures didn't really kick in until 2012, when the number dropped to slightly over 10,000, sorry. The next year, foreclosures plunged to 3,340. Don't think for a minute that this was due to an improving economy. Not at all. It was simply the strategy of desperate servicers. With so few properties foreclosed and even fewer placed in the market, home prices had nowhere to go but up. Optics and illusions. That's why I said this. For years now, data provides mortgage services and lenders have done their best to hide the real mortgage situation from the public. The largest data provides. For example, the largest banks serviced nearly 2/3 of all the first liens in 2011. Their data was reported quarterly to their regulator, the Office of Control of the Currency. By 2019, that had plunged to less than 1/3. What had happened? The housing crash. I've kind of skipped over a little bit, but I don't want to go back and my misplaced. That's why I'm putting a link inside the description for anything that I might miss. But this article is extremely important. The housing crash had left them with millions of seriously delinquent first liens to deal with. This was new territory for them, and they were operationally up to the task. As the cost of servicing delinquent mortgages soared, most of the largest banks simply decided to sharply cut back their servicing business. So they sold most underwater loans in their portfolios as well as the mortgage servicing rights, MSRs. The 2019 FDIC quarterly reported that the large servicing banks sold off $500 billion in mortgage services rights to non-bank services in 2013 alone. This sale of MSRs has continued right through 2019 when $635 billion changed hands. Who bought these loans and the servicing rights remain largely a mystery. Interesting. The consequences were far-reaching. Whereas the large bank services have reported detailed data to the agency which regulated national banks, the OCC, the new non-bank services didn't really report to anyone. This has left an enormous hole in the reported mortgage data. That's where the problem comes at. In its June 2014 mortgage monitor data provided by Black Knight Financial Services reported that its coverage of non-agency securitized loans was slightly more than half of that universe. Hence, it extrapolated in order to estimate the entire non-agency market. In spite of having substantially fewer mortgages in its databases obtained from the major market service, Black Knight has never clarified or admitted how much its own mortgage database plugs since then. Another example of this coverage is shrinkage is what happened to Hope Now's report on mortgage modifications. In 2013, the Hope Now Consortium included 18 major firms that services more than 30 million loans. By the third quarter of 2019, it had dwindled to only 12 firms which service mere 18 million loans. Because of this, Hope Now extrapolated modification numbers have become little more than a guess. Shocking redefault statistics. I know I've done an article on this in the past about how many loans were how they were redefaulting, even being on these different mortgage modification programs. Last October, MarketWatch published my column about the danger of mortgage modifications that redefaulted. It did not include the data below, which shows truly scary redefault figures for non-agency RMBS loans. Look at this. You see this chart here. It shows that. This graph was compiled by Amherst Securities Group, one of the best data providers at the time. It showed redefault rates as of July 2012, broken down by the year of modification. How many modifications were proven in just 2008 to 2010? Hope Now estimated that slightly under 4 million permanent modifications were completed in those 3 years alone. For 2008 and 2009, Amherst graph showed redefaults ranging from 75 to 90% for the peak of the year of modifications in 2010. It reported rates of 50 to 60%. Redefault rates for 2011 modifications. Redefault rates for 2011 were headed towards 40% over a period of less than 2 years. These extremely high redefault rates were not reported by any other data provider. Amherst redefault figures do not include failed forbearances. Forbearances are arrangements whereby the lender agrees to temporary deferred mortgage payments while the borrower deals with allegedly temporary financial problem. The suspended payments are usually pushed down the route and not canceled. And at the end of the forbearance period, a repayment plan often begins with a higher monthly payments. Everybody out there with the forbearances, again, it's going to begin with a higher monthly payment. Hope Now estimated that during the 2008 to 2010 period, 3.4 million repayment plans had been initiated. A more recent study on modification redefaults was published in 2015 by 2 researchers at the Federal Reserve Board. Although they used a relatively small sample of 50,000 first liens, the study showed redefault statistics in line with the earlier report by Amherst. Again, they do a chart here. The graph above shows the percentage of loans modified between 2008 and 2013, which were current and still being paid at the end of 2014. These modified the earliest between 2008 and 2010 were current rates of only 10% to 40%. These mean they have redefaulted at rates between 60 and nearly 90%. According to data's important quarterly report on average profit for home sellers, 2013 was the first year when sellers in many major metros began to see a profit on the sale of their house. It was no accident the greatest gains in gross profit occurred in California and metros, where mortgage services have brought foreclosures almost to a complete halt. 2013 was also a year when the picture began to go dark on the non-agency securitized mortgage market. This very important quarterly report on non-agency mortgages put out by the American Securitization Forum ceased publication that year. The last comprehensive database, which was a reliable source for the non-agency mortgage market, was that of Black Box Logic. Its entire database and analytics software was sold to Moody's in 2016. I have not found any Moody's report which made use of this important database. CoreLogic claims that to have the largest non-agency securitized mortgage databases of anyone. However, I've never seen any of their monthly foreclosure reports which made a connection between the rise in home prices and the orchestrated plunge in foreclosures. What we can infer from all this: first, the true condition of mortgage markets around the country is murkier than ever. Repeat that again. First, the true condition of mortgage markets around the country is murkier than ever. Second, a full picture program mortgage modification redefaults will offer us a much clearer understanding of how bad the delinquency situation really is. Third, data providers show no interest in giving us a more complete view. And finally, don't count on any help from the mortgage services. Repeat that again. Third, data providers show no interest in giving us a more complete view. And finally, don't count on any help from the mortgage services. Juro is a real estate analyst who covers the bubble and home buyers. He has a number of different links. It's definitely worth your attention to pay attention to. This could be the greatest opportunity if things continue to falter, and if you're in a position where you can benefit from it, great. If not, and you're in a part of this, you need to take precautions and take steps now to prepare yourself for a major market real estate crash. That's looking like it's been brewing for a while. I'm talking about it, but really is going to take unfold as this COVID-19 continues. Be safe out there. If this video has been any value to you, please subscribe, leave some comments, and until my next video, I'm out.